taking an unconventional look at stocks, property, bonds, economics, and more. This is the Total Money Management Podcast with Steve Moriarty, Tom Hill, and Jacob Senior.
Hello, welcome back to the Total Money Management Podcast. I'm back, Jacob Senior, with Steve Moriarty and Thomas Hill. How are we going, gentlemen?
Fantastic as usual.
Good.
A bit early.
Righto. Bit early.
You blokes always say welcome back. We haven't gone anywhere. We're here. Welcome to the podcast.
We're not here every week for 34 episodes. I go home and have a nap. I'm not sure about you.
Righto, get on with it.
When he's not knitting his jumper.
It's a bit cold in Brisbane this morning.
I'm gonna sniffle through the next couple of weeks because I'm got a cold or something.
Got your granddad jumper on.
Got my cardigan on.
All right.
It's all right for you young blokes. You'll be. I was just thinking before. I was just thinking, yeah. Well, you'll be 61 one day. Yeah. Just think I'll be 91.
Yeah, we'll be coming to visit you.
No, you won't. I'll be dead.
With the podcast in the nursing home, mate.
I'll be dead.
Oh, well, the here and now. April 22nd to April 26th. There's a few bits and bobs to cover. The big issue, today's new normal, we're talking about moving from stage 1 to stage 2. So business as usual being stage 1, continuous instability, military flashpoints, defense spending starts to ramp up. Into stage 2, which is growing disruption, move to a bit of a beggar my neighbour trade policy, which I think we touched on last week on the podcast as well.
Yep.
Tariff barriers increase, and then defense spending starts to escalate as well. So we're not quite at all-out trade war yet, but we're moving on.
We're pretty close.
We're tracking.
Yeah. Well, it's interesting though, because you do look at that growing disruption, and you sort of go, yep, and you realise we're moving away from the old business as usual. We're well into the growing disruption bit.
Mm-hmm. And the next 10 years will be extrapolated out for an all-out trade war.
Basically, yeah.
It's going to be awesome. So other key points we're wanting to cover today, obviously deglobalization continuing, resource security becoming a growing issue, which is good for us.
Yeah, the critical mineral stuff.
In the land of Oz.
There's a lot going on in that space, shall we call it, as the favourite word is.
Good for our market, maybe for our dollar.
Well, it's good for our industry because the critical metals is going to become a key component of advanced manufacturing, and the special rare earths, lithium.
I remember you talking about copper to me a year and a half
graphite,
ago.
Yeah. All of those are going to become really, really critical in stuff of the future. See, copper is, my understanding is you can't replace copper, in terms of like, we can't use copper. We'll use, something else. It's like, no. Copper's the critical one.
So the gold standard.
And doesn't it take 10 years or more to set up a copper mine?
And that's the problem.
Why is that?
Because there's a lot of regulatory stuff, Tom. Like you can't go in these days because you've got all those rabid greenies going, hang on, there's a special goddamn parrot there, so you got to do a, Parrot Protection Program or something before you start digging. And so it's just, but it's also too, mining's really interesting because when you look at the length, like you say, 10 or 15 years, it starts off with surveying the ground, putting down some holes, checking it out, and it's really quite complex.
A bit of a Google search here. Development stage is usually 4 to 12 years to open an ore deposit for production and costs anywhere from $1 million to $1 billion to complete, depending on the type and the extensive pre-development planning and paperwork.
Wait, is that oil or copper?
That's copper mine.
That's generally applicable to everything. And then on top of that, you've got local politics. You think if you're in Africa or those places, it's just really, there's a lack of infrastructure. Okay, we found this copper deposit. Great. Listen, it's 200 kilometres from the port. Oh, okay. How do we get to the port? Well, we've got to buy a bucket load of trucks. Okay, but we need a road? Well, okay, we're going to go and talk to the government and see if they want to build a road. Then there's all sorts of stuff, right?
It'll be eight years before we turn a profit.
Absolutely. Then we got to get it processed. Okay, where do we got to take it to get it processed? Oh, well, it's got to go on a boat to China. Oh, okay, well, and then they've got to do this and that. And so it's actually quite, there's a really good book, just while I think of it, called The Material World. I can't remember the author. I read it about a year ago. And it's a really good book about sand, the 6 sort of critical...
Ed Conway.
Yeah, Ed Conway, yeah. And it talks about sand and just these resources where it's like the history of sand. It's really quite fascinating, but it's also really intricate, where you sort of think, sand, sand, shit's everywhere. And it's not like that, right? It's special type of sand and, or the
They've
grading.
Sold you on the sand stage.
Well, the grading and all that sort of stuff.
It's in my son's shoes every day.
Yeah. But the thing with that critical minerals is too, the big issue is we are way, way short of it to do the green transition. So when people go, we want, the governments are busy writing things going, everyone's going to have EVs by 2035.
There's the net zero policy.
Yeah. The problem is, it's like, well, it's really nice that you've written that. By the way, we need an 800% increase in the output of copper.
Yeah, I've done the maths. We don't have enough.
Exactly.
Yeah.
And Jeremy Grantham is going on about that and saying, there's another guy, Mark Mills. It's got some really good YouTube videos. Maybe we can whack one in the show notes. But it's a really important issue because what we're going to find is, I suspect what we're going to find is countries are going to start saying, I don't know about these EVs, and because they're going to become horrendously expensive, right, because you're going to have a commodity sort of shortage, you're going to have a huge recycling industry, and this will all be driven by this, government mandate that you've got to have electric vehicles. But what we're also finding with electric vehicles are they're not as sexy as you think they are. The batteries, the insurance costs, and I think we talked about this before, they're way, way less energy efficient than the standard, ICE vehicle or petrol vehicle, right? And so, we're sort of so far down this path that it's the only thing that's going to stop it is where we actually say, guys, sorry, we just haven't got enough lithium to make all of those batteries, to make all the, the solar things, the wind things, the cars, all of that sort of stuff.
I've seen a few places now with people trying to resell their second-hand EVs as well, and they're just not getting anything for them.
Yeah.
The batteries I think there's a 10-year battery life on them most of the time, and if you have it for 5, then why would you pay more than half?
Yeah, because the batteries range from like 15 to 25 to 35 grand.
Yeah.
So, and the insurance costs are horrendous for EVs, right? And all that sort of stuff that you don't get sold on, when you look on Twitter and you see some buffhead in a Cybertruck.
Would be fun.
Well, what else we're covering off today is this time is different or valuation matters. And then we've got a bit on property in there.
Yes,
as
property
well.
again.
Again and again. So where do we kick off, gentlemen?
Well, we just talked about resource security. I'm not sure if we want to talk a little bit more about that.
Well, you can't fight a war without resources, right?
Exactly right, mate.
And things are escalating.
Big time.
I haven't actually. I say this every week. I haven't caught up with the latest on the Palestine Iran last time.
God.
Something got bombed over there. Has there been any response, gents?
No. No. At the moment, the Israelis. Now we're recording this early May, but the Israelis are basically going into Rafah, another area. And everybody's trying to go, no, don't do that, you guys. But the Israeli government's a bit like, we're doing it whether you like it or not. Yeah. So, shit show continues. Next.
Yeah. Next topic, Tuesday. We're talking about buying the dip.
Buying the dip.
So the one thing that people, what definitely frustrates us is people or the industry going, buy the dip. It always goes up. Don't worry about it. You'll be absolutely fine. But the issue is when you actually look at the data and you see when are the days or when are the times, months, periods, whatever you want to call it, that you buy the dip when the CAPE ratio is high, what actually happens then?
I mean, you can see why people say that, right? Because if you look at the since 2009, we've pretty well been in a bull market. So with recency bias, every time it has dipped, it's gone back up. So it's, like in my mind anyway, it's pretty easy to see why people get mixed up about that. But like we keep banging on about, it all comes down to valuation and market cycles. And look, I know a lot of people are familiar with market cycles and a lot aren't. But if you've got volatility and big dips at the top of a cycle, well, the chances that they turn into something disastrous are much higher, right? Whereas if you're buying a dip at the bottom of the cycle or when things are cheap, then, well, there's going to be a higher chance of rebound.
Go and look at the. We've got a session on the website, haven't we? Market cycles, or something.
Yeah.
Is that right?
Well, so it was in our Well 1, Well 2, Well 3 program, but we've just dropped it into the Investing Essentials. And I know Jacob generously has offered a month free for Investing Essentials with no contracts. So anyone who just isn't quite across what a market cycle is.
I like how you've said Jacob's generously. You two have got nothing to do with this.
Marketing manager, Jacob Senior.
Yeah, he's a generous man. Jacob Land.
But anyway,
giveaways.
The video of market cycles is on the website.
Absolutely.
Or something.
It'll be for Investing Essential subscribers. That's where it'll be. But yeah, to Tom's point, the Cape's currently at 35. In the last couple of months, the S&P's down for 6%, 5%, whatever it's at the minute. It doesn't matter. But what we're saying is, people are going to be piling in there, and that still effectively could be the top for something.
Yeah, that -5 turns into a -10 by the dip. That turns into a -20 by the dip.
Exactly.
That turns into a -30. You guys sold me a sucker.
Exactly, but you do that at the bottom where the Cape's 13 or 15 or whatever. You buy a 5% dip, and that the likelihood of that reverting to the mean or reverting to its intrinsic value is much higher.
Yes, there's a study. It's a long time ago, but it's still, I think, valid, which is when you buy at the bottom, or when at the bottom, there's 12 months later, there's usually a bit of a dip, and you can buy. So if let's say it bottoms out of 1,000, right? And you go, and then it moves to 1,500, and you go, oh man, I missed out on that. What happens is it usually drops from 15 back to 13 or 12, and you get another opportunity to get in again. And I think that's psychological, because you buy at the bottom, it goes up a lot in 12 months. Usually the rebound is quite strong in the first year. And I think a lot of people then go, oh, this is too good to last. Okay, I'm going to sell some stuff. And that brings the price down again. But then it turns into a longer bull market. And I think but the important point is you get a second bite at the cherry. And that's when, like you say, Jacob, it goes down 5 or 10 and you think, oh, geez, I'm not sure. But if the Cape's at 12, historically you look at it and go back, 50 years and go, yeah, this has been a really good time to buy more. Whereas, like you said, Tom, if you buy it at 35, it's like, yeah, I bought the dip and then I had to buy another 7 dips. Yeah. Right, because it loses a lot.
100%. Dollar cost averaging can be pretty dangerous when you do that.
Given it's an election year, might be all right, but still, it's a friendly reminder to make sure you just check where valuation's at before you get too excited about it.
Exactly.
One of those.
And asset allocation, all the stuff we harp on about every week anyway. But that actually is something that I might stick in the show notes for whatever they lay, but something on the Facebook page or one of the social media, because that's an interesting chart to look at.
Well, it's really what we're trying to do is say to people, when you look at the current circumstances, because investing is fairly rinse, wash and repeat, what you want to do is go back in history and say, well, what happens when I buy the dip when the Cape is above 25? Okay, well, it turns out to be not a really good long-term idea, right? And that's the point. You use history to say, because, people say that sort of stuff all the time. Oh, the last 35 times it did this, you've made lots of money 12 months later. And it's like, yeah, I know, but if you bought it when the Cape was over 30, actually they're the 3 times that it didn't work. And that's what you want to look at, right? You want to look at the times where what they're saying didn't work, because that's what you want to avoid, right?
Yeah. All right. Well, Wednesday, we're talking about mum and dad investors. We've all been there where we've gone, oh, shit, prices are going up. Let's jump in.
FOMO.
And then we've found out terribly that we've lost all of our money. And penny stocks comes to mind for me. I'm not sure about what you guys think. Maybe Luke Oil.
Yeah, please. Oh, God, you should see some of the screamers I had early on.
Early in their career.
Oh, it's just unbelievable.
Tell us about one. I want to know.
Oh God, tell you about one. Well, there was the one that was.
Didn't you rinse a few $100K in something?
Yeah. Well, how much time you got? No, there was a couple. One of them was those bloody forestry tax advantage things, and the other one was that saffron. I think it was saffron. Like saffron's really rare, right? And it's India's got a lockhold on the production.
That's the spice.
Yeah.
Right.
The global of I think it's saffron, and we did it. They did it sandalwood.
Not tulips?
No, sandalwood. It was sandalwood. There was a lock on. Indians had a lock on sandalwood exports and production and stuff, and we did it in Australia, and it was a tax advantage thing, right? Which is, you invest with us. You get all these tax advantages, and we're going to produce sandalwood. You'll be a zillionaire, right? So I went in there, zip, lost it in about 18 months. And it was this was about 2004, I think.
Is this after it had gone up a lot? And you
no.
Funneling
It didn't even really do much.
Oh.
Didn't get off the ground.
Because it was the old, get in on the ground floor, like be one of the initial investors who lose their money.
You got in at the ground floor, but
I got in at the ground floor
37 levels below.
Yeah, went to the basement. Yeah. So, and I got caught with another one, which was I think was a forestry scheme, that lumber. Same sort of. It's like the ones.
Stay away from wood, mate.
Yeah. Well,
stay away from
the other one that looks popular last few years has been barrels, right? Buying barrels of whiskey or stuff. Like you just look at it and go, oh Jesus, But it's just at the time you just sort of
everything is hot at the minute.
Makes a lot of sense.
Well, when you're a new investor, you think about. I mean, you guys did it, right? You total focus is on making money, and everything looks really good, right? You just, like I say, you read a book on Warren Buffett and you go, right, I'm going to be a Buffett investor. And then you read a technical analysis book, right, I'm going to be a, trader. And then you read a quantitative book, I'm going to be a quant investor, because you don't have any experience to be able to say, well, look, I've tried that and that doesn't work.
The media makes it look really lucrative as well. Like especially when you're looking at something like ComSec and you're going through the each company and what to buy and what not to buy. It's always buy.
Yeah. 95% of things are a buy or a hold.
Maybe we'll do a special on how much money we've all lost. That'll be fun, actually.
That'll be a series, not a special.
Yeah, that's true. Well, relating that back to Australian property investors who have now all tapped out their personal borrowing capacity.
Well, maybe not all.
Well, most of them. Using their self-managed super funds to borrow more. Like, this is the kind of shit that's happening now, where people are tapping into their super funds to borrow more instead of going, oh, actually, maybe it's not a good time to buy at the minute.
Well, the last year, investor loans have increased 30%. So, I have no words, as they say. No clue, as my daughter says.
The scheme continues.
Well, it just seems to be... Oh, God, I don't know. Move on.
That's all right. By the time Max wants to get a house, it'll only cost him 15 mil.
Him? It'll cost me.
He'll just get a 200-year mortgage.
That'll be the deposit for the caravan park.
Just stick him in a caravan.
That's why they're going to push me off into a retirement village, right? They'll push me off into some hovel down on the coast for, $500 a week, and they'll take their zillions and buy a property. Thanks, Dad. Yeah, power of attorney. Yeah, Dad's a bit dementia. He's talking about sandalwood or something again.
He's buying whiskey barrels.
yeah. Dad's discovered a scheme, Scotch whiskey, at the ripe old age of 84.
Oh, God.
Anyway, what else have we got? There's got to be something serious to talk about.
Thursday. So Apple's last decade is certainly not going to be repeated over the next one. And have China just kind of demanded that they remove a bunch of important apps? I somehow missed that. It says here WhatsApp, Signal, Telegram, among some of the apps that were iPhone was forced to remove in China.
Yeah, this week Apple came out and said they're going to do a buyback because they got lots of cash. And because Uncle Warren's on the tide, and Uncle Warren loves buybacks because it makes it worth more money to him. But the main issue there is really, again, just that theme of Apple has got to move away from China. China is now sort of hostile, is maybe a little harsh, but it's not too harsh in the sense that China is now saying, well, don't bring your Apple phones to work. We're not going to put apps on there. So basically they're just muting Apple's sales. I think, don't hold me to it, but I think the sales fell 16% or something. And so in other words, they're declining pretty rapidly, and it's pretty bloody obvious that Apple's going to have a problem in China, and Tesla and these other companies are going to suffer the same stuff.
Yeah, it's all this tit for tat stuff. I mean, the US is saying they can't have TikTok, and then the China are now saying that something to do with WhatsApp, and it's all to do with this end-to-end encryption stuff. They wanted to unlock the encryption, so if they want to view the messages that have been sent between two people, they should, in their mind, they should be able to do that for national security purposes.
Yeah.
And the companies are like, no way. Like, what? The whole point of us doing that is so
It's
you
the
can't
privacy.
see that shit.
Yeah.
So it's just this tit for tat thing that's going on now, and the same with Tesla and how to get their cars working in China using certain apps. So it's
Yeah, the other thing was this week was what they're saying on TikTok is any videos critical of China are not basically don't get a gig.
That's why we haven't got any views.
Yeah, there you go. There you go.
Yeah, thanks, Steve.
We're down on China and property, that's it. No one sees anything. I'll be talking about that in the retirement village. No one ever listens to me. Come on, Granddad, off you go.
But it's just, I mean, the whole Apple thing, just to close off on that one, it seems coincidental with the end of Q1. People are selling off their shares after a good. It could just be that simple as well. People are selling off their shares, taking a bit of a profit.
Yeah, maybe. I mean,
worst
there's always
decline in 4 years.
But just remember, though, for every seller, there's a buyer, right?
Well, exactly.
So, someone's buying those shares. So it just seems, I just think it's a little bit of a signal that tech is going to have a bit of it's not going to be as good the next decade for technology as it has been for the last 10 or, even 20 years. Interest rates are a lot higher. The cost of capital is higher. There's a lot more China's not your oyster anymore because you're not going to sell many products there. You've got higher capital costs where you've got to build factories in Vietnam or in India. So when you look at all that, the spectacular corporate profits that have been tax-free because they're, logged in bloody Dublin, all of that's going to change. And that means that, they probably won't perform as well as they have for the next decade.
Yeah. I mean, I'm just looking at the Apple chart here. Like, it's dropped 6% a couple of weeks ago, and now it's up 8% last week.
Yep.
So it's like,
well, it was up 8%. I think might have even been last night.
Yeah.
Because of the earnings stuff, and
So it just shows like high volatility, high CAPE, high valuation. Like all this is going to be normal now for the foreseeable future.
I think so.
Price is just disconnected from value, right? At the moment.
Yeah, but it's what you see. I was looking at it yesterday. Because someone said, this is a spectacular rise or something, over the last 10 years. And when you go back in history and you look at the up chart and the down chart, it's generally the same. You get a magnificent bull run, right? 1920 to 1929, magnificent. And then you're going to absolute smashing from 29 to 32. Then you get a magnificent run from 45 to, 63. Then you get smashed from 64 to 82. Then you get a magnificent bull run from 82 to 2000. Then the next decade you get, you lose 5% per year. Then you get a bull market from 2009. So what I'm trying to convey to people is this idea of nothing's different. Right, the old this time's different. Well, no, this is just a pretty stock standard bull market. And so when people go, this is an amazing bull market, it's like, actually it's not. It's just a pretty standard one that you see throughout history, right? The CAPE was at 12 or something in 2009. In 1982, it was at about 5. 1945, it was around the same sort of figure. So what I'm saying is, it's just history repeats. But because you're living in this time, like if you guys didn't know about market cycles, you'd be sort of like, wow, man, stock market's on fire.
We'll be all in.
Or, that sort of thing. And that's why I say it's really important to learn about that, because that's the way you go, yeah. It's really, it's on the tear, but I've got to be cautious because, I've had a look at history and it ends at some stage. And that's where I think we try to teach people to take that perspective so they don't get caught out with I'm just going to keep piling money in and I'm going to make a fortune and it'll never go down again, because you get that vibe a lot. This is a spectacular time to be invested. And it's like, well, no, it's just a normal bull market.
Friday, let's talk about some energy index. It's pretty cheap.
It's still cheap.
In the grand scheme of things.
The thing that I thought was pretty interesting in that chart that Steve shared, in 2008, energy made up for about 16% of the S&P 500 market cap, and today it's only 3%. So assuming the same kind of split, the amount of shares are being held and that kind of thing, it just shows everything else relative to energy has outperformed, and it just kind of underscores the fact that energy's underperformed for a long time, reaffirming that narrative. And we like cheap sectors.
That's a market cycle within itself, right?
Yeah.
It was 16, now it's 3.
Yeah, well, it just shows that, the mean reversion principle will kick in at some stage, and it will, energy will outperform. And like you said just then, Tom, the others like Infotech will come back to the field. If, this is I won't go into too much detail, but in the US, they're starting to disassemble the tech bros, right? And the monopolies that they've got. They're starting to, Google is in the courts at the moment about, holding out other companies. Apple, there's vociferous complaints about Apple and the App Store, right? And all that sort of stuff. And that's where they make all their money, right? Because they got these quasi-monopolies. So once you erode those away, then by regulation, then what happens is you open up the field. It's like, what's that thing? Non-compete clauses, right? If you're working for Google, you have to sign a contract that says, well, I'm not going to nick off to Apple or Facebook right? Because that restricts your ability to go elsewhere.
Well, didn't they just take that away in the US?
That's exactly right.
Yeah.
Right? So what they're saying is, well, listen, if you want to go off and start your own search engine, by all means, we're not going to have any of those non-compete agreements anymore. And so what they're trying to do is inject more competition into these sort of fields that have been locked up for a long time. But the important thing to note from that is it's changing from where it's been from the last 10 or 20 years, right? We're changing now into a field where, everything tech was glorious. Well, not anymore. We need to have a look at this, right? And a lot of it's been driven by the national security stuff, right? What governments don't like doing is having all of that stuff locked up in a sector. So the oil sector has been historically totally involved in politics, right? Because it's a key resource. You can't do anything without oil, right? And that's why it's been such a strategic asset. Well, in the last 30 years, tech has become the new oil, so to speak, right? Because national security now is all about cyber attacks on infrastructure, cyber attacks on weaponry.
Just information in general.
Yeah, all that sort of stuff, right? And so that's where governments now say, particularly the US, are saying, okay, how do we manage this, right? How do we make sure that this doesn't get out of control and is used against us?
Yeah, well, let's finish on the last bonus section, which...
Contrary
to everything we've just talked about, the US market's still above the 200 SMA, right?
Yep.
Which is generally a positive momentum.
Still been going up.
It's still going up.
Still going up. Keep going. What about the core? Don't you guys want to do the chore or the card or
the chow?
The chow. The chow.
What is that?
There's no O in that.
Chart
of the week. Yeah.
You have your glasses on? You got your glasses on.
Righto.
Military spending around the world rose almost 7% to a record 2.4 trillion. That's with a T last year. The steepest annual increase in 15 years.
But have a look at that chart.
Yeah, US.
US and China.
US, China,
yeah,
Russia.
but look at China. I mean, China's like miles behind the US.
So what's that? A 40% increase? Is that what it is? Almost a 37% increase.
No. It's the share of military spending. So out of 100%, the US is about 40% of global spending.
They're at least $1 trillion.
Don't F with the US.
Yeah.
And let's end on that one, fellas. We'll see you next week.
All right. Thank you.
Arigato.
Stay up to date on our socials. Just search for Total Money Management on Instagram and TikTok. For your free investor personality assessment, go to totalmoneymanagement.com.au. And as always, remember, we don't provide financial advice.